What are some strategies that dealmakers are pursuing during the recent M&A downturn? What are the biggest headwinds slowing down transactions? How might the elections around the world impact acquisitions? We talk about all of that and more with Bill Curtin, head of the M&A practice at the law firm Hogan Lovells. Hi, I'm Joe Mantone with S&P Global Market Intelligence. Welcome to the latest edition of the Pipeline Podcast, where we discuss all things related to M&A and IPOs. On this latest episode, we speak with
Bill Curtin. I'm a partner and the global head of mergers and acquisitions at Hogan Lovells law firm.
Part of Bill's role is to advise companies on their cross-border transactions. His position requires him to stay focused on the regulatory regimes around the globe. In the discussion, he notes how the U.S. presidential race isn't the only election in 2024 that will impact M&A. Bill also notes that despite increased regulation, companies are still pursuing deals to help ensure that they can keep up with what he describes as the technology imperative. Joint ventures are also becoming more common during the downturn. Up next is my conversation with Bill Curtin. All right, Bill, thanks for joining us today. To start off, I wanted to ask you about some of the challenges that M&A has seen over the last 2 years. Just given that there has been such a downturn, are there certain strategies or approaches or structures that can become more prevalent when M&A is less active?
Well, let me start by saying it's great to be with you, Joe, and I really appreciate the opportunity to talk about something near and dear to my heart professionally, pretty much every day of the year, which is M&A. And I would just put a little bit of context about there have been a lot of commentary and observation during 2023 and looking back at 23 on how that was a down year for M&A, right? We all know that value was down more than volume of M&A when we look back at 2023. And we know that statistically, deal making fell to a 10-year low. I think value was down almost 20% year on year, 17 to 18%. Volume down about 6% year on year. I do remind folks that's inside the context of comparing ourselves against a couple of pandemic and post-pandemic years that were very, very significant in activity. So when you do look back, before the pandemic, and you look at where we are now, the reports of the complete demise of M&A are a bit premature. So yes, we were down in 23, no question about it, significantly by value and less significantly, but still down on volume. But M&A still went on and occurred. And I would say that it went on and it occurred because of what you've observed, what you noted, Joe, which is that people adapted. The deal makers, the principals in the strategic companies, the principals in the private equity sponsor firms adapted and looked at new ways to do an M&A. And I would say that in three respects. The first thing that happened was a lot more mid-market M&A occurred. Because the regulators have been more involved and more engaging in terms of their review and even scrutiny of transactions, we know the value of M&A came down, the volume not as much. And that's just because more was happening in the mid-market. So people were doing more by way of bolt-ons and add-ons to complement, supplement and strengthen and to trim on the other side as the sellers than they were doing sort of the bet the farm, big ticket M&A during 23. The second thing that they adapted to do is different types of transactions. So we've had a very significant upward tick in the number of joint ventures and partnership transactions, collaborations, cooperations even, some of our clients call them, as a way to non-organically grow their business. And then I would say the third point is in the mid-market, M&A continued along because of what a phenomenon that we described, Joe, as programmatic M&A. There's significant research out there. McKinsey's done studies. The Wall Street Journal has reported on it, where companies that engage in recurring or serial transactional activity, they actually outperform their peers who do less of that. And so as opposed to 2007, 8, and 9, when people sort of froze in M&A during the great financial crisis, this time through, as we came out of the pandemic and faced increasing inflation and higher cost of credit and capital, people still tried to go forward more in the mid-market space because they understand that programmatic M&A, recurring, consistent M&A generally drives better returns for them in terms of their total shareholder return indices. So I would say those three things are my observations in terms of the way that people have adapted.
Yeah, it's interesting on the JVs. I haven't really heard too much discussion about that. So those are just a half step toward an M&A deal, would you say?
That's exactly what I'd say, Joe, because if you think about it, M&A by definition exists in circumstances where a company and certainly a private equity sponsor can't do something on their own, right? So they can't do something as quickly, effectively, um, attractively through their own organic means as they can do so by getting help, acquiring technology, acquiring talent, moving into a new geography. That's M&A. And in a circumstance where you have greater regulatory involvement or higher cost of capital or less confidence in the C-suite because of inflation or the like, right? You might not be quite so bullish as to engage in full-throated, full throttle M&A, and therefore you'll half-step your way there through joint ventures. You'll defray the costs through having a partnership. You'll share knowledge. You'll equally contribute or otherwise allocate talent into the joint venture, right? It's sort of like diversifying your portfolio if you're a stockholder, right? You're defraying and allocating and distributing the cost of trying to accomplish something non-organically rather than doing it all on your own. And so we saw a tremendous uptick. So a great example is our team at Hogan Lovells. We do a lot of transactional activity in life sciences, technology, and transportation, moving goods and people. Of course, we now have the the EV move and the automotive space and the freight movement space, right? When you look at most of those transactions, they're happening through joint venture and partnership because the cost to put in charging infrastructures, the cost of technology to develop the batteries to move these vehicles or these freight carriers are so significant that Mercedes, for example, isn't inclined to do it just on its own, right? And they'll partner with others for know-how, for talent, for cost of capital, for penetration and the like. So yeah, very, very significant uptick in that space in 2023.
Do you expect that to continue, or do you think we'll start to see more of a recovery in the M&A proper space?
I'd say yes and yes.
Okay.
I view more by way of joint ventures can be challenging. So joint ventures are not bespoke. You can't use a template document to accomplish a joint venture. By definition, each and every one of them is its own creature with its own type of governance systems and its own type of exit protocols and its own ways of allocating which partner contributes what to the joint venture. So they require experienced advisors and they require a bit of extra effort oftentimes to put it together. But on the other hand, it's allowing parties, as I said earlier, to defray and to allocate and distribute costs and the like. So I do see that as continuing when you think about some of the technology imperatives that are happening in the world, Joe, that have staggering costs associated with them, right? Moving from an internal combustion engine way of moving goods and people to a battery and carbon zero, that's a staggering cost to do that, right? So you could see that in that space, I expect many more JVs and partnerships to occur. The second yes is I look at pure play buy sell M&A with measured optimism for 2024. I think you're going to see value and volume of M&A go back up in 2024. And we could talk about some of the reasons. So my answer is yes and yes.
Yeah. And you mentioned some of the headwinds that we're facing the M&A market. It seems that interest rates were talked about a lot over the last couple of years. Do you see that as the biggest headwind to M&A, and has that dissipated at all?
Yeah, we're right now a little over 5%, right? And we've had an incredible run since I think the first quarter of 2022, the Fed's hiked interest rates 11 times, running up until January of this year, right? So it's been quite something when you think about just the pressure that that's put. And in terms of whether that's the most significant inhibitor, if you will, and why our numbers and value and volume were down. It's hard to think of something as more of an inhibitor than the cost of capital, right? The Feds have talked about multiple interest rates coming this year, but just January, if you look at it, right, Joe, it doesn't tell you when those are coming, right? Maybe we'll get something in May or June. We'll have to see. But the fact is they've done it 11 times over the course of 2 years, and that's unprecedented. So that's a very significant inhibitor, but it's not the only one. We've had extremely interventionist regulatory authorities and the Federal Trade Commission and the Department of Justice, and very openly so, right? They've been very communicative about being policy influencers, policy positioners, in addition to sort of legal adjudicators. So I would look at that as another. I know that from experience that's been another element and sort of the inhibiting category. And I think you also have to look at kind of the nationalism that's played out politically. We've had geopolitical conflict, very sadly, very regrettably, and we've had protectionist regimes through foreign direct investment and through our Committee on Foreign Investment in the United States, what we call CFIUS here in the United States. So there's been, a collection of inhibitors, I would say. And of course, at the end of the day, M&A becomes very psychological. And when you have those inhibitors and you see any slowing and you see that your peers aren't moving quite as quickly, you're less confident and less bullish. It takes a little bit more to continue that programmatic M&A. But the ones who continue, the ones who, like the eagle, flies through the storm, right? The eagle doesn't fly above the storm. It's the only bird. It doesn't fly below the storm. It flies through it. The programmatic M&A companies and sponsors, I think they're the ones who are going to be the winners.
I do want to talk to you more about the regulatory bit, but just on the financing part, have we seen deal financing terms or anything change at all this year so far?
Yeah, I mean, the capital is there. It's just changes the acquisition models, right? And so what the cost of capital does, it's not that the capital has dried up. That's a different circumstance, right? When capital is hard to access and it's harder to qualify for it. It's more that the cost has increased. And when the cost increases, what does that do? It just puts pressure on the valuations. And when you put pressure on the valuations, right, you still have these sellers. Somehow sellers have a longer memory than the purchasers. So the sellers are still thinking, are we really that far from 2021, which is the greatest year in history for M&A? And valuations were through the roof, and every M&A deal was a non-recourse transaction. And I had multiple bidders, right? And I had no financing contingencies from any purchasers. Well, now you have the purchasers like, no, 2021 was a moment ago, y'all. That was a time ago. So no, those valuations, those heady days, no. And those non-recourse. So the cost of capital just puts pressure on the acquisition model, which puts pressure on the delta in valuation gap between the purchasers and the sellers more than it is. We can't get capital to complete the transaction.
Right. But I know rates haven't really come down yet, but it does seem to be that they're holding steady. So does that give buyers more confidence to do deals?
No question about it. I think you nailed it, Joe. I think the way we look at Hogan Lovells, at where the capital is in the marketplace, is that it's stabilized. We think that we are in a stabilized circumstance, both on interest rates and on the inflation metrics as well, right? Both of those we don't expect increases. We expect, if anything, decreases, cuts on the rates, and decrease steady on the inflationary measures. Still costs way too much to go to the grocery store, by the way. But we see more good news category elements there than bad news. It's just really a question of when, right? Are we going to hit it in May on the rates, or June, or protract out a bit more? But we think, I feel very confident with my clients looking at it and say, we're now in a period of stabilization. And remember, M&A's biggest thing is the P word. Predictability. It's not the P word perfection. It's predictability. And so when we can say, hey, these have stabilized, if any movement there's coming to our favor, then transactional activity starts again. Even though we haven't gotten to the places on rates and inflation that we want to get, doesn't matter. As long as we have predictability, the transactional, that's why I call 2024 a year for measured optimism.
Yeah, take some of the unknowns out of the market.
That's all we're looking for.
Sure. Yeah. And then touching on the regulatory bit, we have seen some increased activity of $10 billion plus deals, at the end of last year and into this year. Is that an indication that companies are getting more comfortable with antitrust guidelines?
It is. It's not that, to their credit, it's not that the FTC and the DOJ in the United States or the CMA, because remember now the United Kingdom with Brexit has its own regime. 47% of worldwide M&A emanates from the United States. So we're still the locomotive. Even so, what happens in Germany, what happens across the continent, what happens in Asia, even though China is not in its best moment, clear, right? What happens in the UK now separate from continental Europe, all that matters. Washington is aware of where Brussels is on the regulatory front, and Washington's aware of where London is on the regulatory front. So to their credit, the regulators haven't retreated from their positions on how they should view non-organic activities. They haven't retreated from their views on some of the concerns in the technology sector, for example, right? What I think has evolved is the ability of the deal makers to structure their transactions in a way that gives them confidence that their transactions will get through. Might their transaction, Joe, take longer than 5 years ago? Yes. And might it cost more to effectuate the transaction? Yes. And might they need to be prepared to defend their transaction through litigation? Yes. But whereas a couple of years ago, those were sort of fresh developments that deal makers had to reconnect themselves with after a pretty long run of not being so concerned with them. Yeah, that was 2 years ago. Now they have refreshed the tools and the capacity and the awareness of those elements. And that starts to, like in the stock market, it starts to get baked in and it starts to get rolled in. And that then marries, Joe, with people saying there's this technology imperative. I can't really afford to stand still and to wait to feel more perfectly comfortable about regulatory intervention. I need to move because technology is moving. Consumer expectations are moving. The IRA from the government is out there with all of its incentivization and I can't stand still. So the intersection of what I call the technology imperative, which runs across all the sectors, and greater awareness and I think confidence with respect to how to work constructively with the regulators means M&A rises in 2024. And M&A in the B range, in the mega deal, the $10 billion plus $20 billion transactions, those start to return as you've seen.
Yeah, whenever someone asks me what sector M&A is going to pick up, I always say technology, because it touches on all sectors.
One time I was asked the same exact question and the excellent interviewer rattled through a number of the sectors. And I said, I don't know why you have plural sectors. There's only one. Technology.
Right. So, but that's on the bigger deals. But on smaller deals, there's also some regulatory changes coming out with the Hart-Scott-Rodino Act. They're asking for companies to provide more information on pre-merger notification documents. Do you think that'll have a chilling effect at all on smaller deals?
I don't ultimately. They've raised the threshold for reportable transactions. And they've also, as you've rightly noted, Joe, increased the disclosure and information submission and provision of data elements. I don't think it's going to be enough to headwind remember that technology imperatives. I don't think it'll be enough, but I will tell you, people take note of it and must comply with it. And it's not a nothing. So I'm not giving you one of those waffle answers. It won't inhibit it at the end of the day, but the guidelines that have come out specifically for private equity and the serial acquirers with the roll-ups, of course, our clients take note of that and are aware of that and seek advice and consultation from us. But at the end of the day, I don't see those additional elements as inhibiting.
It's just that they'll have to factor in at the beginning, like as you were saying earlier.
That's right. And remember those guidelines. To your point, Joe, the agencies are not just focused on the 10 billion plus transactions, right? I mean, they specifically speak about multiple small acquisitions.
Mm.
They don't talk about just the big ticket. So respect to them. They're very clear. Serial roll-ups and transactional activity, even in the smaller, lower mid-market and the like, they're aware of that and they're going to be looking at that. But I don't see them as inhibiting the forward march.
Mm. And financial sponsors, private equity firms, they're often a part of the roll-up strategy. They've been a little bit sidelined in the last couple of years in M&A activity. Are we seeing them get more active?
Oh, for sure. There's almost $2 trillion of dry powder hanging out with our sponsor friends, right? And, where they are in their world, I mean, their DPI, you know, that's important. They have to transact and they have to move and they can pause and they can reflect and be careful and judicious for a while, but they're not like strategics. They have a monetary imperative, a distribution imperative, a DPI imperative, right? And so you're going to see, it's a remarkable thing. If you look at the trend line of M&A and the allocation between strategics and sponsors, I believe the statistic now hovers between around 30%, even last year in a down year, a very down year for private equity. 3 in 10 transactions involve private equity sponsors. It's gotten as high as I think 34 or 35% before the dip last year, Joe. So, you're not too far off from 1 in 2 transactions involving sponsors, right? So they're here to stay. Their role is hugely important and they have so much dry powder that they're going to forge forward. Yeah, they have to be mindful of the FTC's views and the DOJ's views on serial transactions and roll-ups and the like, and how they're aggregating the way they look at those transactions, but move forward, they will.
I don't know if you've noticed, but this year is a presidential election year. And there seems to be different viewpoints on whether the election slows down M&A or whether it doesn't have an effect on M&A at all. What's your take on that? Does M&A slow down during election years?
Well, a couple thoughts on that. I have a particular view on it, Joe. The first is, it's a remarkable statistic, but if you look at GDP, Joe, around the world, and you take 50% of that GDP, it relates to countries that will be going through elections this year. So we, of course, think about the US election, right? But if you think about worldwide, over 50% of global GDP is going to be going through determinative elections in the course of 2024. That's significant stuff. Agree? That is not just, of course, 48% of worldwide M&A emanates from the United States. So get it. And we've got quite something coming, right? Get it. I just remind your viewers, your listeners, that there's a lot happening around the world. You go to London, I go there a lot for business. We're one of the largest law firms in the world, with one of the largest law firms in a London key market for global economy. They're going to go through something. We don't know exactly when, but it's coming in 2024. So that's the first thing I just remind my clients, which is that's going to affect regulatory positions in Brussels. That's going to affect it in London. That's going to affect US-China relations, right? There's a lot that's going to be happening now. The second thing here in the United States, I'm looking more at the United States Senate than I'm looking at the presidential.
Really?
Everybody likes to talk about the presidential, right? Okay, looks like it's going to be a close call. Who knows? I say 2 things about this election. One, it's still a long way away. A lot will happen. Not can happen, will happen between now and election day. Right now, it looks very close. Okay. But the Senate is what I will really watch, because I don't believe the presidential itself has an impact on M&A. I do believe the Senate does. And the reason I say that is, let's say the United States, the American public goes Democrat in November. Well, what does that mean? It means you have to look at where the Senate is. Because if the Senate goes Democrat, then you've got something, right? If the Senate goes Republican, it's mitigated, right? Same thing the other direction, right? So what I'm really going to be watching for as much as the presidential is what happens in the Senate, because if you get the executive in the Senate, then things can happen that impact M&A. If it's split, I don't believe it does. I think it's too much mitigation in our system to be able to affront the technology advance. And I keep talking about that, the technology imperative to go.
So yeah, that's a interesting point. Yeah, obviously, yes, the executive branch can do a lot more if they have control of Congress.
You get to Republican executive and Republican Senate, then tax law changes, right? But the margins are so tight that the Senate really can't. It's very hard for it to override executive. There's mitigation and checks and balances. So, but if you line up, right, with the same party in both, then you can see some policy and legislative action that could, yes, indeed, on the back end of this year into 25, adjust us. But as we march forward through 24, until we know how that all raise with the executive and Senate, I don't see that election affecting us.
Right. And then on your point about all the global elections, what do you advise clients? Is just that there's so much out there, we really can't navigate all of them. And
well, you look at the key markets and you say to your clients who are all of them are doing cross-border mergers and acquisitions right now, right? And we're doing at Hogan Lovells, we're doing M&A transactions in Singapore and India. We don't have a presence in India because of the VAR rules, but we have clients investing in India, across the Middle East, into Saudi Arabia, into the Emirates. We're all over. And, you cannot, I always remind our clients, we have a very strong legislative group at Hogan Lovells, Senator Coleman and Aaron Cutler and wonderful folks, H.P. Goldstein. I remind folks all the time that there will be impacts on geopolitical and economic circumstances, given the fact that over 50% of global GDP will undergo determinative elections this year. I can't predict which way they will go, but I do say to them, don't just look at the United States, because I think that would be misleading for them to do so. So if we're looking at doing something very significant in continental Europe, we always tell our clients, in continental Europe, these are the countries that are going through election years. Will the UK go from conservative to Labour? Well, right now, the statistics and polling suggests that they will. At the same time, the UK economy is lifting. The data shows that it's behind us, but lifting out of the recessionary environment. Well, will the move from a conservative government to Labour stymie that? So we always take mind is this is an unusual circumstance this year with so much of global GDP wrapped up in elections.
Yeah, well, it'll certainly be interesting to see how it all plays out. But Bill, I really thank you for taking all this time with us here, and hope to maybe have you back again one day.
Oh, it's really a pleasure, Joe, especially to talk to somebody who knows the M&A world as well as you do. So thanks so much from me and all of us at Hogan Lovells.
Well, that'll do it for this latest episode of the Pipeline Podcast. Thanks for listening.